Treasury yields are climbing again, and that is putting the stock market's recent rally under real pressure. Here is why it matters. A Treasury yield is simply the effective interest rate the government pays when it borrows money. When that rate rises, it ripples through the price of nearly every financial asset: stocks, real estate, corporate debt, consumer loans, all of it. The logic is straightforward. When government bonds pay more, investors can earn a better return without taking on the risk that comes with owning stocks. That makes bonds more attractive by comparison, and it forces investors to ask whether stocks are actually worth what they are currently trading for, especially shares priced at high valuations relative to company earnings. Right now, that question is getting harder to answer in stocks' favor. Higher yields also work through the broader economy. Companies that need to borrow to fund operations or expansion face higher costs. Consumers carrying mortgages, auto loans, and credit card balances feel it too. When those costs rise meaningfully, corporate profits can come under pressure. And when profits come under pressure, stock prices tend to follow. This tension between bonds and equities is not new. For much of the past few years, markets have been navigating a period in which the Federal Reserve pushed interest rates sharply higher to fight inflation. The Fed has since started easing policy, cutting its benchmark rate from the peaks. But here is the important distinction. Longer-term Treasury yields are not set by the Fed, they are set by markets. They move based on the economic outlook, inflation expectations, and the basic supply and demand for bonds. That means yields can, and do, move independently of whatever the central bank decides. So even as the Fed eases, market-driven yields can climb if investors start pricing in a stronger economy, stickier inflation, or fewer Fed rate cuts ahead. That is a dynamic worth watching closely right now. A sustained move higher in yields would test how much further the equity rally can run. The rally has been built in part on expectations that the Fed would keep cutting rates, lowering borrowing costs and supporting stock valuations. If those expectations fade, the math behind current stock prices gets more difficult to justify. For now, the bond and equity markets are locked in one of their classic standoffs. Neither side has forced the other's hand yet. The practical takeaway: watch the direction of Treasury yields in the weeks ahead, as closely as you watch the major stock indexes. In this environment, the bond market is effectively setting the ceiling for how high equities can climb. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.